Unless you've been living under a rock, it is no secret that the Federal Reserve has been raising rates recently in order to deal with inflation. This has been driving up borrowing costs all across the board, from everybody from the government with their 2-year bond being close to 5% now. This has been driving up borrowing costs across the board, whether we're looking at the US government borrowing for 1 year at close to 5% now, or whether we're looking at mortgage rates that have recently hit about 6.5%, or whether we're looking at average credit card rates, which have recently hit a high of 19%. This means that for pretty much everybody who has anything to do with debt whatsoever, people are aware that interest rates have been getting more expensive. But there's one interest rate that really has not been increasing across the board at a similar rate as borrowing costs, and that is the interest rate on savings and checking accounts. Now, this is a big question as to why interest rates on bank accounts have not been increasing, because that's where borrowing comes from. Basically, when you make a deposit at the bank will use that in order to authorize them to make a loan to someone else. And if the interest rates on loans are so high, meaning the bank is getting paid a lot of money off of being able to use your funds, why is that not getting passed through to you, the saver? And depending on where you bank, this could be really, really extreme. Take a look, for instance, at the Chase savings account. Right now, on all balances, you could get a whopping 0.01% on your savings. Not 1%, not 0.1%, but 0.01%. This means that if you deposit $1 million in a Chase savings account, you'll receive a whopping $100 per year in interest on your million. Now, this right here is Bank of America's current interest rates, which are a little bit better at ranging between 0.03% and 0.06%, but still really nothing to write home about. Wells Fargo gets a tad bit better. If you have up to $1 million or more, then you can get 2.5%. But to be honest, most people who have that amount of money are not keeping that in cash. And so most people are going to be getting 0.25%, maybe 1% at Wells Fargo. Now, this is not universal. There are some places you can go to get a little bit better yields on your cash. If you open up a savings or a cash account with a brokerage company like Charles Schwab, you could get close to 0.5%, or with Fidelity, you could get 2.34% right now. And NerdWallet shows a variety of online bank accounts that give you some whopping returns at 4.5% to 5%. Though to be honest, most of the names on that list I have never heard of before, so I have no idea how safe they are. They're probably real, I just don't know about them. But it begs the question, when we look at interest rates at the most popular banks for the majority of Americans where they're going to be keeping their cash, they are not making anything on their savings, despite the fact that interest rates from the Federal Reserve have been jacked up to decade highs. This right here is a chart of the federal funds rate, and this is the amount that the Federal Reserve is paying to banks on their reserves. So while they're getting a risk-free 4.5% to 4.75% on your money, they're passing through a whopping 0.01% of that. Now, before getting filled with outrage and closing down your bank account, it's important to understand what is going on here and why interest rates for the average checking or savings account has not increased yet, even though the Federal Reserve is trying to increase interest rates across the board. To understand why, let's take a little bit of a trip back in history about 3 years. This right here is the Federal Reserve's balance sheet. This is the amount of assets that they own. And you can see in the fallout of the financial crisis, they bought a lot of mortgage-backed securities and treasuries to buy all those assets off the bank's balance sheet so the banks wouldn't go under. They continued to increase their balance sheet, and they topped out about $4.5 trillion during this time frame. Well, they started to get rid of them, and then at the beginning of 2020, they realized, oh, we're going to have to buy a lot more assets. So their balance sheet went from about $4 trillion to $7 trillion basically overnight. Now, very simply, that means that the Federal Reserve, they printed $3 trillion and they used that $3 trillion to buy things like treasuries from the open market, from banks. Now, when you buy something, that person gives you an item and you give them cash. The same thing happens with the Federal Reserve. They get the treasury or the bond from a bank or from the open market, and they give instead cash. So $3 trillion basically overnight just entered the financial system. Now, most of this cash was borrowed by the federal government. So a lot of that cash that got injected into the banking system was then loaned to the United States government, and they would use that cash to spend money on various programs to try and stimulate the economy, to try and rescue Americans from COVID. Or I should say, rescue the economy from the consequences of their regulations and their decisions. This is a chart of M2, that is a measure of the money supply, meaning how much total money there is. And you can see immediately there was a big increase in the amount of money that was in circulation, and that continued for quite a while. So follow the train with me. Federal Reserve prints a few $1 trillion. It goes into the banking system. Banks lend that new cash to the US government, and the US government then spends that money. So where does money go when anybody spends it? When you spend money, money goes from your checking account to the grocery store's checking account. And then they take their money and they spend it on things like new supplies and employee paychecks. And then that money goes from the grocery store's checking account to the supplier's checking account or to their employees' checking account. And then when those people spend money, again, it goes into other checking accounts. So every time money is spent, it's just going from one person's account to another. Now, despite the fact that you and I just naturally see banks as a place where we store our money, or at least the amount of money that we plan on spending, that we're not going to be investing, that's really not what banks like to do. They do not make money on deposits. Deposits are actually liabilities for banks, because as soon as you give them that dollar, they owe that dollar back to you. This means they have to offset that liability with an asset. And so what they do is they go out and they make a loan to somebody, or they buy an existing asset, buy an existing loan, or sometimes buy stocks. This way they have an asset that offsets the liability on their balance sheet. So yes, they do owe you that dollar, but if push comes to shove, they do have an asset that they could liquidate in order to meet their liability. So by now you might be starting to see the problem with all this printed money, because when the Federal Reserve printed these few $1 trillion and that money got injected into the banking system, that was a bunch of new cash that started making its way into various bank accounts. So banks were flush with deposits, and they couldn't go find assets anywhere to offset all those liabilities. This led to all this money flooding into the reverse repo facility at the Fed, which is where banks can go to basically borrow collateral from the Federal Reserve. So when we look at all of the reserves that banks have right now, they've got about $3 trillion in traditional reserves, and they've got about $2 trillion with the reverse repo facility. That means banks together have close to $5 trillion of total reserves, including the amount of money that they are using to get collateral through the reverse repo facility. So why am I going on about reserves? Well, this shows the amount of true liquidity that is in the banking system right now, meaning there's a ton of cash. And we can see this by looking at the money supply. It expanded rapidly following the response to 2020. And yes, the money supply has started to decrease over the last 12 months or so. And we see over the last 1 year a decline in the money supply, but obviously it is nowhere close to the amount that it was increased by. So what in the world does this have to do with interest rates? Well, it comes down to what interest rates communicate about money to the economy. Interest rates are simply the price of money. That's what it costs to get your hands on money. Now, in a completely free market where, let's say, the money supply is not governed by an entity that can increase it or decrease it at will, but the money supply is dictated by the free market, such as a pure gold standard where the only way to get more money is to sell something or to dig more money out of the ground. In that case, the interest rate for borrowing money is going to be determined by the supply and demand of money, just like the price of anything else is going to be dictated by the supply and demand of that item. If tomorrow everybody winds up with 100 1-carat diamonds in their room, they just wake up and find it there, then the value of diamonds will decrease drastically because the supply will have gone up drastically. Similarly, if tomorrow the amount of wheat gets cut in half, well then everything that is made from wheat will skyrocket in price because the supply went down and the demand will stay somewhat similar. What does this have to do with interest rates? If there is a ton of money, then people will have a ton of money, which means they won't need to borrow because people have a ton of savings. And so if you have savings and you want to lend it out, you're going to be competing with all the other savers out there who are also wanting to lend it out. That means interest rates are going to be low. And anybody who does want to borrow will have plenty of savers to be able to go and borrow from, and will be able to bid those prices down, and will be able to borrow at a really great rate. This incentivizes spending and taking risks because there's no incentive to keep on saving that money. You're not making anything on it. So go out and spend. The savings pool is abundant. Go out and borrow at low rates and spend, take risks, and cause some growth because there's a large cushion in the economy to fall back on. On the opposite hand, let's say there is not a lot of money because everybody has been spending money. Well, suddenly the savings pool is scarce, meaning that nobody has a lot of savings. So if you want to go out and borrow, there's not a lot of people out there to borrow from. That means the lenders, the ones who have saved, they'll be able to demand a very high interest rate because they're not competing with anybody to lend. And so you, as the borrower, will be forced to pay a premium to get something that is in low supply, in this case, the money. Those high interest rates will then incentivize people to save so that they can become the lender, so they can make a large amount on their money. The low supply of money will increase the amount of incentives for saving with those interest rates being high. It is a self-stabilizing system, the free market response to the supply and demand of money. Interest rates will dictate and keep somewhat of an equilibrium and incentivize the savings pool to grow when it's small through interest rates, and incentivize the savings pool to shrink so that you can have some growth when it gets too large. But as you may have already guessed, we do not have a free market in money. We have a 100% top-down controlled market in money. This means that when the interest rate and the quantity of money is set by a small group of individuals, the likelihood that it is the correct quantity of money and the correct interest rate for money is almost zero. The chances that you are going to have the money supply be too abundant or too scarce, or interest rates too high or too low is almost certain. So when we look at the federal funds rate, and we can see that they've been increasing the amount that they're paying to banks on their reserves because they're trying to disincentivize spending. This does not solve the problem of the quantity of money that they increased over the last 3 years. Supply of money is still abundant. So yes, banks are getting paid a massive amount on their reserves right now, but there is still a ton of liquidity in the system, meaning that banks are not competing for depositors because the savings pool is large, at least in terms of the quantity of money. And so banks aren't having to compete against each other in order to attract depositors because there's just a too much amount of money still out there that people are like, hey, well, I can't go here and get a higher interest rate, so I might as well just leave it here. And keep in mind what that signal sends to people. When interest rates are low, it signals don't save, there's no point, go out and spend because the savings pool is abundant. So why do you think inflation has still persisted this long? But it's not all bad news, and it will not stick this way. On a recent episode of Odd Lots, which is a podcast by Bloomberg, it was detailed that while during a tightening cycle, the average interest rate passed through from the Fed to depositors was only about 35 to 40%, but that didn't stay the same over the entire cycle. At the beginning of the tightening cycle, only around 10% of what the Fed did made it through to depositors. But by the end, it was about 75 to 80% of what the Federal Reserve did made its way through to depositors. In simple terms, that means the longer the Fed keeps on tightening, eventually it does have the desired effect of making the savings pool scarce, meaning that those interest rate hikes eventually do make their way through to depositors. So your checking account and your savings account will eventually reflect those higher interest rates, assuming the Fed keeps on tightening long enough for that to happen. In the meantime, if you are really intent on getting higher interest rates, you can always look at some of those online bank accounts. You can look at 1-year treasuries. You can look at T-bills. You can look at money market funds. There are some other options out there if you want to have a cash-like debt instrument and get a little bit of a higher return on your money. There are options to do that out there. But if you're patient and you like the liquidity more than anything right now, assuming the Fed keeps tightening, eventually interest rates will get there. As always, really appreciate you guys. Thanks so much for watching. Have a great day.